The latest Morningstar active passive barometer has shown that passive strategies continued to outperform active ones, even in a volatile year with movements that would normally favor active managers. However, fixed income bond managers did better versus their passive peers than managers did in the equity space. I'm here today with fixed income strategies analyst Jeana Doubell. Jeana, first off, are passive strategies as dominant in the fixed income space as they have become with stocks?
Hi, Lucas. Not at all. We actually find that passive investing is less entrenched in the bond market. So, for example, within passive strategies in the global equity universe, the AUM for passive strategies is about 50%, whereas it's only 28% in global fixed income.
Now, the managers of these still dominant active funds, they were able to respond more nimbly to last year's rate hikes by shortening duration. That was a key advantage over passively managed bond funds, and still passives outperformed. What advantages do passively managed bond funds have?
Well, while some corners of the market are less efficient, others are a lot more so. So, for example, within government bonds in developed markets, there's a very high level of efficiency, meaning that there's less opportunity for active managers to outperform. Active managers are also prone to market timing risk. So while they can dial up or down duration in response to macro factors, it's very difficult to get these calls consistently right. Often it also comes down to fees. Within active funds, we see really high fees, such as in the Euro high yield category, where the fees are about 86 basis points for the median fund. In comparison, in the Euro government bond category, we have lower active fees at about 40 basis points in the median fund. But in passive versions of both of these categories, it's even lower, ranging from about 15 to 30 basis points.
So these active managers, they have to make up for higher fees, and also they have an asset class in front of them where there are fewer inefficiencies to exploit. And yet more client money remains with them versus passives. So why is that? Where are they still outperforming?
Well, it definitely depends on the category. Within European high yield, we know that issuances often come from smaller, less well-known entities, versus in the government bond market, specifically in developed markets, we have a lot more freely accessible information such as data on interest rates, economic data, and political moves, which is a lot more easily accessible and therefore reflected on a lot quickly, making it more difficult for active managers to perform. Yield spreads have also historically been a lot tighter in the government bond market, meaning that fees play a greater role. So essentially, within high yield, there's more space for active managers to outperform, but in government bonds market, it's a little bit more difficult.
So it's about picking the right type of strategy for the right type of bond. Do you have an example of a European high yield bond that is actively managed that you would recommend?
Most definitely. So within Euro High Yield, I have the gold-rated Candriam Bond Euro High Yield Fund. This lands within the top 1% of the Morningstar category, which includes an impressive 76 passive ETFs that it's competing with. It's led by a stable, tight-knit team, headed up by Nicholas Julian and his predecessor, Philip Noyard, who are both actively involved in the security selection process. They've been working together for 13 years, building a very compelling track record. But here, the key is the investment process, which is ultimately risk-aware and research-driven. It relies a lot on deep fundamental analysis, which really helps it outperform in the Euro high-yield space. So even with a fee of about 64 basis points, which is about 30 basis points higher than its medium passive fee that it competes with, it's still managed to beat both active and passive counterparts.
Meanwhile, you mentioned government bonds as an area where passive strategies are in an advantageous position. Do you have an example of a passively managed government bond fund?
Sure. We have the gold-rated iShares Core Euro Government Bond UCITS ETF. Here, the managers use stratified sampling to track the Bloomberg Euro Treasury Bond Index. So they basically mirror the maturity, country, and credit quality of this index by a similar split. In addition to this, the managers only rebalance the fund about once a month, which helps minimize transaction costs, ultimately allowing them to offer a fee of about 10 basis points. Altogether, this has helped them beat about 70% of peers in the category over the last 10 years, an impressive feat.
So active or passive may be right for you, depending on which segment of the bond market you're looking to invest in. Thank you for explaining this, Jeana. For Morningstar, I'm Lukas Strobl.